Michael Burry sold all but one of his holdings because the market is set to collapse due to the mother of all crashes. He also referred to it as the biggest speculative bubble in history. Michael Burry's portfolio contained 11 stocks, with a combined value of nearly $165 million last year. He had, however, sold over a third of his holdings. According to his Q3 report, people are utilizing his six-stock portfolio, valued at just over $42 million. People wouldn't pay him any attention if he were simply some random man. Michael Burry, though, is not your average investor. He made millions of dollars during the dot-com bubble by foreseeing the crash and betting against the market. But that wasn't what made him so well known. It was the fact that he bought a share in GameStop before the company went viral and bankrupted hedge funders who had shorted the stock. His main decision was to take the housing crash into account. He identified a bubble that was going to collapse after studying the market. As a result, he stacked everything on the housing market, which was seen as foolish at the time. However, as is customary, the bubble burst and Burry made a fortune for both himself and his clients. Therefore, there is a strong likelihood that a bubble will be formed if Michael Burry notices one. It doesn't take a genius to realize that the bubble wasn't brought on by the Fed's recent activities. It is merely a bubble in a single industry. Everything that develops the bubble. House prices have almost doubled in the last 2 years, and despite adding little to the market, cryptocurrencies are worth trillions of dollars. As a result of easy access to capital, stock prices double, turning the market into what Michael Burry refers to as the biggest bubble ever. Although people still don't know how and when it will rupture, they are certain that it will hurt. Find out which stocks the wealthiest people are dumping, what kinds of assets they are holding in these tumultuous times, and when the mother of all crashes will occur. Why have millionaires started selling stocks in large quantities? Everyone anticipated a crash, and since the market did drop, their predictions came true. The fact that it is not the end is the sole issue. Each of the two men who founded Google, Larry Page and Sergey Brin, sold shares for almost $1.8 billion. The second richest man in the world, Jeff Bezos, has sold more than $9 billion worth of Amazon stock. The shares of Tesla that were sold by Elon Musk, the richest man in the world, were valued at about $12.7 billion. According to Bloomberg, the $43 billion in stock sales made by American millionaires last year will more than double the $20 billion in 2020. Despite the fact that inflation is close to double digits, Warren Buffett has a cash reserve of nearly $30 billion. It is true that it is less than the previous year because he invested heavily in oil and gas, gave the current boom in the energy sector. The profits of oil firms are among the largest ever. That will most likely go on for 1 or 2 more years, but $30 billion is still a large sum of money. But why don't they invest that money as owning stocks is a better option than retaining cash? The answer then is both yes and no. Producing money is the most crucial component of every business, since a dollar today is worth more than a dollar tomorrow. Of course, you may argue all you want, is that the company exists to provide high-quality goods, improve the world, or whatever else you want. But at the end of the day, investors' top priority is making money. Therefore, the financial component is the most crucial. The whole point of capitalism is to achieve that. Money, though, is not created equal. A company is worth far more if it is profitable right now than if it will be in the future. They must determine the net present value of future cash flows and how much future gains will be worth today, because time and money are equal. There is a very straightforward formula known as DCF, discounted cash flow. N is the year, and the formula formula is 1 divided by 1 plus the interest rate to the power of the period. For the sake of simplification, let's assume that their interest rate is 5, which will be our discounted rate. Let's imagine a company earns $2 million annually, or $10 million over the course of the next 5 years. If people use the method, the $2 million that the business will make in a year will be worth $1.9 million. In 2 years, the next $2 million will be worth $1.8 million. In millions, the third number is 1.7, the fourth is 1.64, and the fifth is 1.56. If you add them all together, they combined value with the almost $8.6 million. Therefore, even though the company might make $10 million, its actual value is just $8.6 million because it will be 5 years from now. What happens to the discounted rate when the Fed raises interest rates then? This reduces the value of future cash flow relative to today's cash flow, which causes stock prices to plunge, particularly for tax-exempt stocks that are frequently geared toward making huge profits in the future. After gaining market share, the rate of interest ranges from 225 to 2.5%. However, inflation is still high, hovering at 9%. And J. Paul is adamant that he will take any necessary steps to lower it to a manageable level of 2 to 3%. Why does that matter? Future cash flow will become much less valuable, which will lower the value of businesses, which will lower the value of stocks. Of course, the companies that make a profit right away will succeed. However, tech giants like Tesla, Google, and Meta constantly place their bets on the future, and it won't just be another crash. Between 2020 and 2021, 80% of all money was produced, which resulted in tremendous inflation as well as bubbles in every industry, such as the stock market bubble, real estate bubble, and a cryptocurrency bubble. Burry is convinced that the greatest crash is imminent for this reason. He and other billionaires are doing their best to sell as many stocks as they can because they know that if they did everything at once, the market would collapse due to an oversupply. Therefore, nobody wants to watch that. Furthermore, a crash only requires you to wait a few years before practicing climbing back up. It doesn't spell the end of the world. Prices return to their 2007 peak 5 years after 2008 crisis. Therefore, by 2022, anybody who bought a property, even at the height of the housing bubble, made money. Time is a great healer. However, it is merely a limited resource that you are unable to replenish. The stock of Geo Group, a publicly traded firm that makes investments in private detention centers and mental health facilities in North America, Australia, South Africa, and United Kingdom, is the only stock that Michael Burry didn't sell. That doesn't give people much optimism. Burry appears to be certain of just one thing, that more people will end up in jail, particularly once the mother of all bubbles burst. Michael Burry is more of a trader than a long-term investor, has shortened Tesla, profited from GameStop, and actively traded equities, none of which are things that most people would choose to do. The Buffett approach is far more applicable to the typical person. He made investment in profitable businesses, such as oil and gas companies, that may raise their prices in the face of the crisis. Necessities like iPhones, MacBooks, or overvalued banks like Ali Financial are examples of necessities. Every crisis offers a chance, and everyone around the globe suffers from inflation. Yet oil companies and low-cost producers profit greatly. What are your thoughts on Michael Burry's warning that the bubble will collapse? Please let me know by leaving a comment below. And if you enjoyed this video, please press the like button, turn on the notification bell, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you in our next video.